Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's check in with Jay Hatfield. He's the CIO, Infrastructure Capital Management. Jay, how do you think about 2026 here? Because we're coming out of 2025. I mean, great equity returns, really solid returns in the fixed income space. If you're in commodities, gold, silver, platinum plated, boy, you're looking good there. How do you think about 2026?
Good morning, Paul and Alexis, and Happy New Year. Well, we remain bullish. We were bullish this year still. We have a 7,000 target, which, by the way, you should sell targets, not just buy them. So it's okay if we fade a little bit before 7,000. So we use the same methodology that we did this year, 23 times 27 earnings consensus, and we get to an 8,000 target. So that's almost 15% from here. So we're bullish, and this is normal. The rally in metals as well is normal when you come out of a Fed tightening cycle.
And I'm going to ask you what I've been asking all of our guests today, and that is leadership in this market in the new year. We know that we've seen a rotation into value. Is that going to continue to the extent that it becomes the new leader for this market and tech maybe takes a bit of a backseat?
I believe so. We have what we call GARP models of the Mag 8, so it includes Broadcom. And last time when we had 69.40, the upside of those 8 companies is only 2%. So they're fully valued, even assuming they're pretty high growth rates. And if we look, we have dividend funds, so we have every sector. And a lot of those companies are super cheap, pay great dividends, have good growth, and trade at really low market peg ratios. So that's normal. Same thing, normal. When you have a Fed loosening cycle, there's rotation into other sectors, including small caps. So we do think that'll continue. And we're happy about it. It benefits our funds because we have small allocations towards tech in our income funds.
Jay, we came into 2025 with a new administration here thinking that financials would be an area that would really benefit from, if nothing else, a lighter regulatory touch here. Talk to us about financials, how you look at that sector.
We had a little bit different take on it in that, I used to be an investment banker, so I can kind of
That's too bad.
sense when things heat up. And so we were super bulled up about the big investment banks early in the Trump administration, and that was a great call. The regular banks have lagged because the Fed has lagged. So we think this year there'll be a rotation. Not the investment banks won't do well because they're blowing out their earnings, but they're very fully valued. But we're recommending investors rotate into what I call boring banks or standard banks, like CFG. We hold that in ICAP, our dividend fund. And we're even more bulled up about the private equity firms because they've been unfairly punished by this irrational fear about private credit. So we would recommend rotating from the investment banks into standard banks and into private equity.
And I want to bring up, we started this conversation talking about commodities, copper topping 13,000. We've got silver and gold at or near all-time highs. What do you do with the commodities trade next year?
Well, I think you have to be a little bit cautious because if you look at charts, they're pretty far away from their moving averages. And gold did break down when it blew out well above its moving averages. I think a bigger question is really oil. Oil's been horrible, which is great for inflation, by the way. The 70s inflation was really 80% caused by oil. So super bullish for inflation. We're modestly constructive on oil, 55 to 65 this year. We think that OPEC's not going to increase production as much as it did last year. So we're more constructive on oil. There will continue to be rally, particularly in silver and copper, have an AI electricity play, but just be a little bit cautious because it has a momentum element to it as well, whereas oil has negative momentum.
Jay, you mentioned dividends here. We don't talk that much about dividends because it's all about big tech, and most of the tech players don't pay dividends here. What's your dividend strategy? How do you think investors should think about dividends?
Well, I think particularly for more conservative investors, it's good to have a substantial amount of dividends that can cover a significant portion of your cash needs. And then the rest of it, your portfolio, you can have in higher risk, higher volatility companies. So we love preferred stocks. PFFA is our flagship fund, has a great yield, has good total return. We do like high yield bonds. If we're right about the market going to 8,000, then you want to be in the riskier part of bonds. And as I briefly alluded to, there's a ton of really high quality companies like Philip Morris, Nextera, that are not overvalued, have strong dividends, good dividend growth. So we do think that you'll actually get paid for that. It's usually kind of a thankless proposition, but you'll get paid for that. Because when there is a rotation, those stocks tend to do better because when you get money flowing in, they're looking for bargains versus just looking for the latest AI trade.
So will small cap stocks continue to get some love next year? Because I was looking at the Russell 2000 up about 13.5% year to date. They're sort of not the sexy index, right? The Russell 2000, but do you see support for it next year?
We do. We have a small cap fund, SCAP, and I would urge investors that whether you do it yourself or hire people like ourselves, focus on the money-making companies, because that's where you stop gambling and you start investing. So if you invest in profitable companies, they retain earnings, grow earnings. So small caps are attractive if you curate them for being profitable. And what's the biggest trade you're making there is it is a non-tech index. So the value part of it's only about 10% tech. So it's really part of that whole trade. It's not that small caps borrow way much more money or have super high amount of floating rate. It's just the normal rotation out of tech into other sectors. And although the small cap sectors do have slightly lower valuations and do have upside, like Digital Bridge, you mentioned earlier, right? It's a smaller cap stock. So you do benefit from M&A as well. So we do think it's going to be a good place to be next year, and it has been since the Fed became more dovish. It's worked this year as well.
Jay, thanks so much for joining us. Always appreciate getting a few minutes of your time. Jay Hatfield, CEO, CIO, Infrastructure Capital Advisors, also a reformed investment banker, did some stints at Morgan Stanley, CIBC, Oppenheimer, all those haunts down there in the city. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Paul, when you look at it, we're heading into the new year with a lot of the same old problems and concerns, right? We've got tariffs, inflation, debt. We still have global wars going on.
Yep.
Yet the VIX is pretty low compared to all that. So our next guest says that might mean the market a little complacent. Maybe we're ignoring the risks. Joy Yang, head of index product management at MarketVector Indexes, joins us in studio. Joy, good morning. Good to have you here.
Morning. Thanks for having me.
Is this market getting a little too comfortable, and are we ignoring the risks?
Yeah, I think it's a good time for us to just step back and look at what's happening. So we're looking at another 20% year in the markets. And I think we've just gotten used to 20% because we saw it last year, we saw it the year before. But we now have over 100 years of data on the markets. And do you know how many times that we see the markets deliver over 20% 3 years in a row?
It's got to be pretty low.
It's very low. We've only seen it twice. And the last time was the lead up to the dot-com bubble. So that was 3 years of positive 20% returns, followed by 3 years of negative returns. So I think investors have to be careful because on average, we only see the markets deliver about 11% returns per year. But we never see 11. Sometimes we'll see 20, which means next year we'll see maybe negative 10. But on average, you get 11, 12, 13% returns. So what's unusual is we've seen 20% returns this year, low volatility, everything else rising, gold, copper, silver, even value, as you mentioned before. So this has got to be a little bit kind of, uncomfortable, and yet, people are euphoric about AI. And again, where did we come off at the beginning of the year? We had tariff uncertainty, we had Fed policy uncertainty, we had high government debt, we had AI, is it a bubble? And we had geopolitical tensions.
We have all those things right now.
Exactly. Nothing has changed, and yet, the market still seems to be going up. You get market returns for taking on risk, and the risks are still out there. But that said, does that mean people should get out?
Right.
Timing is not going to be good.
How about diversifying? Maybe we saw even a little bit earlier in 2025, people diversifying outside of the U.S., maybe going to European equities. And we weren't sure whether that was just a short-term trade, maybe a longer-term rotation. How do you look at diversification outside the U.S.?
So I think price still matters. And then you asked earlier, everything seems expensive. Well, I say look outside of the U.S. because I think we tend to think of, just U.S. markets. Markets outside of U.S. still look like they have good valuation. So international markets, emerging markets. This year, they already had a strong rally, but that's on the back of being under allocated and under noticed, in the previous years.
You mentioned we didn't have a lot of volatility this past year. Is 2026 the year that comes back, and why?
Well, something's got to give. You can't have high returns, low volatility. So either returns have to come down or volatility has to go up. And I think one thing that's interesting about the VIX is because it doesn't seem like it's telling us the fear of, what investors are really feeling. Because if you ask anybody, they are thinking about, is this a bubble? But it's not reflected in the, VIX. So I think we tend to look at crypto markets and Bitcoin. We have the crypto heat index, which is telling us fear is high. We saw Bitcoin crash and, it's still hanging around that fear indicator. So it feels like the VIX is just holding its breath, whereas, crypto markets are really measuring the pulse of investors.
Yep, looking at Bitcoin here for Tom Keene, just under $87,000 per token. We've been anywhere from $70,000 to $127,000 this year on
Talk
Bitcoin.
About volatility.
Exactly right.
Yeah, but that's also interesting because, Bitcoin is negative this year. But for, Bitcoin holders and ETFs, it started back in January 2024.
Yep.
It's up. It's delivered still 100% returns for investors.
Absolutely. Alternatives, private equity, private credit, I don't know, hedge funds. How do you guys think about alts these days?
I think it's interesting because we're seeing this, the launch of the number of ETFs, indexes that are trying to measure this space for kind of daily flows into an area that's meant to be a long-term buy and hold strategy. So what's the right price? You can't look at it every single day. And it's meant to be a diversified holding for investors. So I think investors should allocate to alternatives.
What percentage do you think? Because I've talked to registered investment advisors, and I would have thought, they're not really interested in alts, but they are. And I would have thought maybe the allocation would have been 5%, 10%. They're talking much higher than that. How do you guys think about it?
Well, I think with everything, it's really based on your own risk allocation. People say even 20% gold now, but that seems quite a high. Yeah. And that seems like nobody's up there at 20%. It should never be a core portion of your holdings. And if you have 20% to gold, 5% to private equity, it builds up.
Yep.
What does that leave your core holdings?
I'm going to put you on the spot, Joy, and ask, where are we going to see leadership in 2026? Place your bet.
Okay, that is on this spot. And I would say still look at a diversified global allocation to all assets, but adjust it to, their weight in the markets, which is still have a, solid portion in equities and bonds, but also think about your allocation to whether it's gold, Bitcoin, private equity. So, be strategic and long-term about it rather than what's driving next year.
How about just in terms of leadership in the equity markets? Boy, AI has been really the story for, 3 years now. Is that still, can we hang our hat on that big cap tech trade, do you think?
I think AI is a disruptive innovation, but, can it come from a $5 trillion company? People haven't noticed the leadership that's building up in Asia. China's coming up with really innovative, disruptive companies, and I think people should be more diversified in their AI holdings.
Joy, thanks so much for joining us. Really appreciate it. Joy Yang, she's the head of index product management at MarketVector Indexes. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, you go outside, you go over to Europe, the Euro stock index, adjusted for currencies, up 33%. How about that? Asian indexes up, mid-20s returns. So everybody's making money in the equity markets here. What do we do for 2026? Chris Kampitsis joins us here. He's a managing partner, Barnum Financial Group. Chris, investors had a really good 3-year run in equities. They made a lot of money in the bond market in 2025. What's the conversations you're having with your clients as to expectations for 26?
Yeah, that's a great question. And expectations, I think, as we look to go forward into the new year, the reality is if we look at how the last time we had 4 double-digit up years in a row, that didn't end so well, right? That ended with the dot-com bubble burst. And so if we're going to see another double-digit, high momentum, high growth kind of year, we're going to need some kind of Goldilocks economic and stock performance in order to do that. So what has to happen for that to be the case? Well, first, we need to see those accommodative interest rate cuts from the Fed. 2, unemployment obviously can't get too out of control. And third, we can't have any AI bubble burst. And that means we need technology companies to really show and prove when earnings season comes along. The market didn't react too positively to the last couple earnings seasons, even though these big tech companies delivered great results. And so that leaves us a little cautious headed into the new year.
So if you're cautious, and you talked about tech, Chris, if you're widening out, I see in your note, you like utilities, which makes a lot of sense because in an environment of lower rates, but also all the electricity, all the data centers, right, that are being built to support AI.
Exactly right. So we think of that as almost an AI adjacent play, if you will. What are the sectors, what are the industries, what are the companies that are going to benefit from artificial intelligence, but aren't necessarily the semiconductor companies themselves? And thematically, if we can see real companies start to increase their profit margins and their earnings as a result of actually implementing artificial intelligence into their businesses, well, that's going to change the conversation from is this a bubble to how high can we go, in a positive and healthy manner.
Chris, talk to us about how you think about investing in the U.S. versus non-U.S. and maybe that's developing markets, emerging markets. How do you think about that? So,
if you look at the typical investors, U.S.-based investors portfolio, it's extremely S&P 500 centric. S&P 500 almost has a monopoly on the average investor's portfolio. And 2025 was a year in which the international markets, waved their hands and said, hey, take a look at me because we're here too. And meanwhile, you have governments who are evaluating their trading partners, right? We saw that with Liberation Day and the tariffs and the tariff negotiations that have taken place since then. So as countries are looking to really reestablish their trading relationships, and then companies are looking to similarly diversify their supply chains, and then on top of that, you have this weakening dollar, it begs investors to start to take a look at other economies and other markets as complements to their U.S. portfolio.
I'm curious where you're looking in the world. I mean, I know we say Europe, we say emerging markets, but when you sort of drill down.
Sure. So one country that we find very attractive right now is Japan. In general, companies in Japan have very cash-rich balance sheets. There's been a renewed focus in Japan about delivering shareholder value. You're seeing a big increase in buybacks. You're seeing a big increase in dividend hikes. And then you have a much more accommodative fiscal policy the last couple of years. And what's interesting about Japan is, the knock on them for a long time has been an aging population, but an aging population also lends itself to automation and technology enhancements. So we think it's a perfect opportunity for Japanese equities. And then, of course, with the strengthening yen, weakening dollar, for U.S. dollar-based returns, that's a real positive for the U.S. consumer and investor.
We haven't talked about Japan for 30 years, but it's back in vogue here. I mean, is this something that's a longer-term trend? And my son's about to do a semester abroad in Japan, and he's all in on Japan. But I'm like, all right, that was in 1980. That would have been a good call. But maybe it's coming back here. I don't know.
I think it is, because ultimately, we have the volatility of what's happening with AI and a little bit of political uncertainty in the U.S. and, of course, conflict and tensions with China. People are looking for a consistent story, and Japan looks to deliver that here. And they've got a lot of the characteristics of what could present a big opportunity that started in 25, and I think the momentum will continue into 2026.
Just crossing the tape here on the Bloomberg Terminal, red headline: SoftBank to buy Digital Bridge for $16 per share in cash. So there you go.
Speaking of
Merger
Japan.
Monday, baby.
Yeah, exactly. Even on a holiday week.
Yes.
Back to the U.S. for a minute, Chris, and we ticked some boxes, talking about utilities, talking about tech. What about consumer staples? What's the outlook, the prognosis for them in 2026?
I love that question, because what happens is technology has been driving the market, both in the short term and long term. I think most people would agree AI has a tremendous long-term thesis, right? But as we see these valuations reach these highs, we want to start to look to take some profits off of the table. And then the question becomes, where am I putting that portion of my portfolio if I'm trimming slightly from my technology and my growth story? And so consumer staples provides a tremendous contrarian almost allocation, one that is inflation friendly, one that provides a consistent dividend in a lowering interest rate environment that in essence pays us to wait. And we saw this in April, right? When the tariff craziness took place and the market reacted, S&P was negative 15% for the year at one point. Sectors like consumer staples really were a bright spot in a stormy stock market. And I think consumer staples will perform exceptionally well going into the new year, should we see the pullback in technology.
What are you doing, Chris, in the bond market here? We had some nice high single-digit returns in 2025. And if you took some credit risk, doing pretty well rewarded there. How about in 26?
If I'm going to take on risk, I'd prefer to get that risk through dividends rather through yield at the moment, especially because the biggest risk to 2026 is stock market volatility and a worsening economy, right? Those are the traditional concerns around what could the end of a bull market be as we potentially go into theoretically a recession, right? So I don't want to own the types of bonds that are going to act like stocks if the stock market's going down. So if I'm going to own bonds, I want quality. I want a little bit of a duration in a lowering interest rate environment. So I would favor, obviously, sovereign debt, and I would favor cash and dividend stocks.
Very good. Chris, thanks so much. Appreciate it. Chris Kampitsis. He's a managing partner for Barnum Financial Group. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I want to talk a little more fixed income, because what a year it was for fixed income, and can 2026 continue that run? Vanessa McMichael, head of corporate and public entity strategy at Wells Fargo. Vanessa, I'm going to jump right in here with something you call cash segmentation, because we are expecting, or at least the market's expecting, 2 interest rate cuts from the Fed next year. And you said in that scenario, cash segmentation is important and will be back in style. What do you mean by that?
Well, thank you for having me this morning. Yes, so for the clients that I cover are corporate and public entity investors. They're using fixed income markets to enhance their cash management process overall. And so they're typically not chasing yield. They're more interested in liquidity and safety above all else. And why am I kind of rambling about this at the beginning of my answer to this conversation is because for the past couple of years, it's been really easy to do very little and generate really nice income for your organization if you've been camped out in cash instruments. And so prior to this inverted yield environment that we've been living for, at least if you're a front end investor, organizations, they would bucket their cash, right? You have your operating cash, you have some strategic cash, maybe you have some cash set aside for a specific project, and then you're using fixed income markets to invest that cash until you need it. But again, because of the yield curve, because of the way last year or this year, we're still in 2025. I'm already trying to get into 2026. The way this year started, liquidity was the number one conversation we were having with clients. And how do you satisfy that liquidity goal? Well, you camp out in a cash instrument. So it's just time for organizations to reframe how we're thinking about using fixed income markets in their cash management process, because we're in an environment where the front end of the curve should no longer be inverted if expectations come to fruition by the end of this year. And so we do need to think about segmenting and putting cash on different parts of the curve. So that's what I mean by that.
Vanessa, I mean, if your job, now I know you went to Chicago Business School, which means you like math. So right off the bat, I got a problem here. How about the 2-year Treasury? I mean, 3.5%. Isn't your job kind of done? You could say put yourself in 2-year Treasuries for 3.5%. That seems like a nice return.
Well, and you bring up a really good point, because we're still in an environment, and we're going to be, at least for the foreseeable future, for this particular investor base that I cover that invests so short on the yield curve, where you don't have to take a lot of credit risk to continue to enhance your yield and stabilize some income generation. So we are in our seats, we are encouraging those clients that can invest out on the belly of the curve because of their investment policies and because they have the cash that they may not need immediately, right, for the foreseeable future, to look at that part of the curve, because a 3.5% yield over a couple of years is still really decent income, particularly for this investor base.
What's going on with money market fund assets, Vanessa? Because they reached record highs. There was all this talk about we're going to see a bunch of outflows. That never really came to fruition. So what's your outlook for MMF asset growth?
We think they're going to continue to grow. I mean, this year we kind of hit 2 new records, 7 trillion, and then 8 trillion. We think growth going forward may be a bit more incremental. Our clients, our corporate and public entity clients, are using money market funds as a substitute for bank deposits. And so they're going to continue to do that. And I think even if the Fed does execute 2 cuts, so we're 50 basis points lower on the front end, at some point 50 basis points lower on these money market funds, that still puts us at about a 3% yield. And that's still really attractive for these clients. Remember just a few years ago, and I'm saying a few, maybe it was 4, where rates were 0 and we were only earning, call it 1 to 2 basis points in these sort of funds. So to earn 3%, to be honest, is still a really decent yield, and it's going to generate decent income. And so we expect to continue to see clients heavily utilize those instruments going forward.
Hi, Vanessa. Thank you so much for joining us. Really appreciate it. Vanessa McMichael. She is head of corporate and public entity strategy at Wells Fargo, advising her public clients on the fixed income market and where to allocate capital there.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.